There's been a lot of stuff that we've talked about today, Steph. You and I have these conversations quite often. A lot of them we record, but every time we have a conversation with any one of these guys, I'm always left with a whole lot of things to think about. So to do it all in one day with everybody here has just been like ridiculous. I mean, it's such a download of information. I'm not quite sure what to do with it all just yet.
I'm not either, but fortunately we have a lot of time to stew and digest.
We do.
Over some cocktails and conversation. I'm sorry, I'm just very distracted by this Pez dispenser that you handed me. It doesn't take much. Well, that and the shirt.
Well, yeah. I didn't want to be a pirate, but I'm a pirate. So listen, why don't we just open the questions up to the floor first, because we've had a lot of chance to talk up here, and you guys have been fantastic at listening and answering questions, so we'll give you a chance to point a question at anybody you like up on this stage. Gentleman over here, I see a hand up. Cautiously.
Oh, there we go.
There we go.
I actually have a question for Mr. Wilkinson. Both Mr. Zulauf and I apologize, the gentleman, the energy gentleman that's not up there, we're talking about the potential or high probability of the end of the euro or the European system, and you sort of went the opposite tact and talk about, if I heard it right, maybe an end of the United States system. What do you think of the possibility of a European breakup?
Is that addressed to me?
Just you, or anybody, I guess.
Well, I've been consistently wrong on this for the last 25 years, so I'm not quite sure what my. I think the euro is was a failed construction from the start, but the political will to keep it alive, particularly as it benefited Germany so dramatically for most of that period, is. And without the Germans actually admitting that it was benefiting them, that has kept it going far longer than I thought it would. I don't believe it can continue to exist. I don't think it's healthy. I think there will need to be either a realignment around a core bloc, Germany, France, Holland, maybe, and maybe another currency, a sort of Euro 2 for the other more high inflationary, less diversified economies of the South. But I just can't see it surviving the next significant crisis. I can't. Nor can I see the institution of the EU surviving in its current form. And if you want to read Viktor Orban's speech that he made to a summer festival in Hungary to students this year, to have an extremely articulate juxtaposition of the views of somebody who is primarily interested in preserving the integrity of his country compared to the European Union that is more interested in dissolving the individual states to create a superstate, then you can do no better than to read that. It sets out the two divergent programs perfectly.
Can I just add something to that, actually? You guys have all borne witness to the US election cycle and the way the coverage of that has been in the mainstream media. I'm not sure how many of you are aware of Viktor Orban as is he the president or prime minister of Hungary? I forget what the title. The prime minister of Hungary. Here's a guy who's been absolutely pilloried in the press in Europe and labeled far right, labeled Nazis. You're all familiar with these terms. But as Stephen said, if you read the speech he gave this summer, you will find something very different to the way in which he's been painting. And I think that is the institution fighting desperately against those who are willing to speak out against it. And I think that's something, given what Stephen and I talked about, it's worth everybody in this room being aware of, is that when you read these labels that are attached, particularly to politicians these days, they all bear closer scrutiny, and they all are worth reading these things for yourself to understand really what they're talking about. And I think another great example of this was Giorgia Meloni in Italy, who was voted in a couple of years ago. Again, fascist, far right, all the labels that we've been used to seeing thrown at people who are anti-establishment, let's call them. And she has governed remarkably well. The Italians love her. She has the air of a real stateswoman. And she's nothing like what she was painted before she got into office. So just as a general thing, just be aware that the same way you guys were bombarded with this stuff over here for the last 2 years, you're having the same kind of information fed to you about politicians in other countries. So I think that's just worth mentioning. Do we have any more questions? I see a hand over here. Gentleman in the front.
This is,
sorry.
It's actually in the back over here.
Gotcha.
This is for Bob, but other people can comment too. Bob, I was at your speech at Morningstar, and in it you said, I hope everybody in the world indexes, so I guess we have you to blame for that. But and then you said, except for me, I think meaning that you were going to find tons of different opportunities when that happened. Has it kind of played out like you thought? Are these opportunities out there that people aren't taking advantage of, and how do they come to be?
It's gone slower than I thought back when I made that, and that was a comment that I made with John Vogel when we first met. And so we have indexing now at about, I guess, 58%, so we're past the halfway point. It does create problems and difficulties for active managers when you have this one-way flow of capital and stimulation. So I still think we need more time, and I would really like to see a gut-wrencher of a downturn. That's when I'm happiest. You know, I always, when it's going to hell, my favorite song is Zippity-Doo-Dah.
Gentleman in the front. Yes, please, sir.
Yes, thank you. So there's an old saying that you never want to meet your heroes. I think in this case that's not true. This has been such a terrific day, so thank you all for putting it together.
Thank you.
Mine's a corollary to that question, which is, you know, so much of the market is now indexed. You have a lot of covered call writing, which I think is sort of piggybacking on that phenomenon. How does this unwind, and kind of what might that look like? Like, what are some of the nasty consequences that could take place if that bid starts to go the other way, if people start to go out?
Who is this question for?
Anyone?
Anyway.
I'd say give it to the big guy.
The big guy.
I look up to him.
Figuratively, gravity, right? These things, all trends are cyclical. So you have times in the 70s where everybody put their money with the trust banks, and that was sort of indexing at the time. And while it was happening, it was not good. But when it changed, it changed. It changed quickly. It's too late. You know, the Graham and Dodd, the interesting thing they wrote in 1933, they were looking back at the 28, 29, saying, what did we do wrong? But they're saying, really, the last thing you could do during a mania like that is do analysis. Not only does it not help you, it hurts you. But, you know, once things broke in 29, it's too late, right? You don't want to play these indexings when it's happening. 99, somebody mentioned earlier, they were right, the most painful time in my entire life was the fourth quarter of 99. And everybody knew indexing was the place to be. And then it just picked up the first 2 months of 2000. There was no catalyst. There was nothing. I think it was March 7th or something. All of a sudden, things started going our way, and my IQ went from 50 to 200, just like that, and now it's back to 50. But I think that's a cyclical phenomenon. And something that cannot go on forever will not go on forever, and it won't. Trying to predict how is not the point, I think.
Yeah, I'd actually add something to that. From my experience in Japan, you know, I went over to Japan in 1989, early March 89, and that was the last vestiges of that crazy Japanese equity and real estate bubble. And the market went up every single day, more or less, for like 10 years. And it was the wonder of the investing world, and Japan was the future, yada, yada, yada. And I remember being in the office in Tokyo on New Year's Eve 1989. Excuse me, the market closed at another all-time high, and it closed at lunchtime, and everybody stood up on the desks and were clapping and chanting when the market closed. And that was a Friday. We came in on the Monday, and the market went down, and it kept going down for like 15 years. Nothing happened. And along the way, you know, the Bank of Japan started raising rates, but the market just stopped going up. It was the strangest thing. There wasn't a crash. There wasn't an event. it just got exhausted and it just started going down. So I think, I think a lot of us, we all spend so much time thinking, what's going to be the event that changes this? And I think that's why a lot of people, really smart investors that survive in this business, they don't look for that. They get to this point where they feel like, okay, enough's enough, and I'm just going to be a bit more cautious, and I'm going to step away from it all. And if I get a signal to go back in, I'm happy to go back in, but for now, I'm just going to kind of sit this one out. And that feels to me where we are.
Yeah, I would add one thing. Although it's really hard to pinpoint the economic or financial market catalyst, Mike Green has done really good work on what the natural flows into index funds are, and certainly an exogenous event that causes the unemployment rate to go up a few hundred basis points would change the flows just because less money would be coming in with each paycheck. But there's also a demographic angle to it, which he pinpoints sometime in the next, few years, less than 5 years, the flow of baby boom retirers and becoming net spenders from net savers and less replacement because of the birth rate, 21 years ago versus the birth rate 71 years ago or 81 years ago, is going to turn the tide, all else held equal. All else won't hold equal, but maybe all else will actually be negative and will exacerbate that.
Yes, please.
Grant?
Bob had one more comment.
Oh,
I'm sorry. Go ahead.
go ahead.
Oh, I'm sorry.
So two quick things. Passive investing. Just pause for a second and think about that. That's everybody sitting in an airplane. Everybody in search of certainty, but absolutely no control. When there's turbulence, suddenly control becomes an enormous concern. And so I would not underestimate the speed at which people seek to get control. And here, folks are talking about long-term time horizons for the decline. I think we got a great preview of what declines look like in our interconnected internet world with the Silicon Valley rush. And I think we all underestimate the speed at which markets can move, the volume at which can be moved, and to me, the high potential for discontinuity and market closure.
I would add that you're looking for a catalyst. One of the things I'm looking for is, I believe, the economic data that is being published today by the federal government is the worst I've seen in my entire career. The error factors, the lack of sampling on data, particularly on employment data. So now that we've had a change in administration, do we have, shall we say, a reevaluation of the economic data? And I remind people that back in 1996, I was on a panel about tips. And all three managers, including Bill Gross, were excited about them. And I said I wouldn't touch them with a 10,000-foot pole. And the reason why, I'll clean my act up this time, that a certain woman of entrepreneurial means would tell you how good it was going to be. And that was the government. So I coined the term at that time, I need to be compensated for GIRR. GIRR, Governmental Index Repricing Risk. And then 8 months after the fact, they changed the CPI. They said, aha, it's overstated by 100 basis points, so they lowered it, and the tips fell out of bed, and they went from 320 to 435 quicker than you could say tips. And I got about 43% of my fund into them. So I would be cautious right now that the economic data could change very dramatically. And as Steffi knows, we've had 5 years of no growth in full-time employment. And if you assume the inflation rate is higher than it really is because of what's been done, then real GDP is far lower, and you have a different perspective. So I think there's a risk for governmental repricing risk and how people will view the environment.
Love that acronym.
Grant, in the back. There really hasn't been a lot of mention today about the war in Ukraine and the Middle East, and maybe we just have fatigue over those stories. But is there any comments on, what might happen and what the impacts might be of these continuing wars?
I think you should give it to the Brit.
I'll take a stab at it, and hopefully someone will join in.
Serious question for
Yeah,
very
yeah.
serious.
I mean, the simple answer is it's really, really difficult to know. I think there's an enormous amount of fatigue with it, as you point out. When I looked at Trump's victory, it occurred to me that an easy win for him, potentially, would be the Camp David photo op with Zelensky and Putin. Both sides are exhausted by this war. We all know that a compromise is going to need to be made somewhere, and if the stories that we've read are correct, a compromise was on the table very early on. Supposedly, Boris Johnson went to Ukraine and said, "No, we don't want you to compromise. We want this to keep going." I don't know if that's true or not. I'd be surprised if Boris Johnson could find Ukraine, even if he got on the right plane. But
They put a trail of money.
yeah, trail of money. Yeah, exactly. Just follow the euros. But I think, in all seriousness, I think there is an easy win here for Donald Trump to at least broker some kind of uneasy peace, either in Ukraine, Russia, or Israel, Hamas. And I think we've seen, since he became the president-elect, we've already seen stories about how the sides want to sue for peace. So, I think for him, if you can fast forward 12 months and imagine Donald Trump being awarded the Nobel Peace Prize, I think that would certainly, as we say in the English, cause a few knickers to be in a twist. But I think now with this change of administration, I think there will be a move towards finding a resolution to one or both of those conflicts, and I think that would be very popular with citizens, not just here in America, but in Europe as well, where there's an awful lot of money being funneled to these conflicts, and people are very tired of it. So I have no basis of knowledge to say that. It's just me looking at the situation and working out what options are potentially available now, and that seems like a sensible one to me. I mean, there may be other people here that have a thought. Peter?
Yeah, I have two related. One is go back and look at history. Nixon reelected landslide, similar phenomenon that you then have the Vietnam peace settlement moments later. So that sense of good feelings. At the same time, I pay attention to the price of natural gas as barometers of Kremlin mood. I know none that is any better than that. And that suggests, given where prices are, if prices keep rising in Europe the way they are, we may see a more willing Kremlin to undertake that. But be careful if it falls back again.
Hello. So this question is for Ms. Cochran, actually in kind of a vein of the previous question. And in honor of today being Children's Day in India, why was India not brought up today?
Well, very simply, no, I mean, it's very interesting because in general, emerging markets are very inexpensive. And then India is this amazing outlier. It's extremely expensive. So a lot of people love the growth of India and are paying a premium for their stocks. We also love the growth, but we can find that we can buy companies that are compounding book value per share and growing quite nicely for 30% of book value, and so that's where we're focused. But certainly if the market changes, we'll be in India as well.
Can you hear me okay?
Yeah, we got you.
So Felix really brought this up, but it was a common theme throughout many of the speakers' remarks. And if no one has any answers to this, Grant, I would appreciate if you can ask Felix during your next conversation with him.
Okay.
But if bonds aren't going to be that hedge to your portfolio, that whether it's 60-40, they're not going to be that positive carry put option where yields go down, price goes up when stocks sell off. What else would be? He suggested it would be commodities, but oftentimes when stocks are selling off, commodities, even gold, they're selling off as well. Bob, I think you alluded to this with tips, so if any of you have any insights into this, be happy to hear that.
Can I make one just overarching observation, and that is, given the amount of leverage underlying so much of the financial positioning right now, I think it would be a real challenge to identify anything that isn't going to get thrown out with the bathwater. If you get into risk off, everything is going to get tossed just because there's going to be a general reduction in exposures across the board and an unwinding of all that leverage. So I think the best approach, or the one that I've sort of settled on, is picking those assets where the hit will be the shortest and the shallowest, and that will recover the fastest, but not to presume that you're going to escape unscathed in the initial sell-off. That would be my...
Yeah, I think Richard Russell said, nobody wins in a bear market. The guys who lose the least are the real winners. And I think if you go back
short selling.
Well, yeah. Yeah.
Yeah, but you're the only one who can do that.
Si, it's illegal. It's illegal now. You know that, right? Well, actually, we'll jump in a second. I just want to make this extra point. Going back to 2008, gold kind of broke its $800 previous high in March when Bear Stearns went under. And then when Lehman went under, gold fell like 30%. But it's still, you could still buy more units of the S&P, and gold bounced very, very quickly. It was just everybody's source of liquidity. So again, it comes down to time horizon, and whichever assets you want to own, it's understanding why you own them and the potential short-term risks you face with that position. But I think, say, something like gold, you kind of know it's going to get hit, but waiting to buy it when it gets hit, you may never get the chance, because the hits get shallower and shallower as the problems get bigger and bigger. But sorry, I am interested in short selling as a way to hedge yourself.
I've said all that needs to be said. Two words.
You just need to give us the list of companies to short,
That's right.
when,
That's
and
right.
when to cover.
Yeah.
I can throw my 2 cents in. I wouldn't be surprised if everything doesn't go down as everybody's predicting, but that's not necessarily true. I'm old enough now to have a long-term, we talk a lot about the 1970s because I remember it. And everybody seems to know that when interest rates go up, gold goes down, and everybody's kind of confused that hasn't happened lately. But look at history, that's exactly wrong. In the 1970s, interest rates went from nothing to 22%. Did gold go down? It went from 35 to 800. Then we had 20 years of rates dropping, so that should have been good for gold. Gold went from 800 to 255. People need to remember that money used to be copper, nickel, gold, silver, and bonds are claims on money. The idea that bonds should be safe and other forms of money are not, it's just not right. So if we are, like a lot of people think, saying this mirrors the 1960s, guns and money, and the things that everybody's been talking about start to go into the system, why shouldn't it be like the 70s, that stocks have a tough time, bonds have a tough time, and gold goes up big? I'm not saying that will happen. We just should not assume it's not going to happen.
During the 2008-09 debacle, one of the areas that performed very well for us, because we had done the underwriting, were POs in the mortgage area, so that when the rates collapsed and there could be the refinancings cycle, you'd buy the POs at a big discount, and we made several home runs with that. So that would be an outlier in the area that would be not on your traditional scale of what would be beneficial in a rapidly declining economic and stock market environment.
So So we've heard a lot of awesome, interesting views today. Grant, right here.
Oh, sorry. Hey, buddy.
Go full.
Hey, Adam. Sorry.
What we didn't get a chance to hear is from you, Steph, about your economic view post-election and what that means. So if you could just spend a couple minutes like letting us know where you stand.
I was trying to avoid this moment. Darn it. Well, post-election, I guess, maybe I've been influenced by my kinship with this gentleman to my left, but I feel like the outcome of the election is certainly better than the alternative would have been for the economic growth prospects. But I think we're at a point where we just can't grow our way out of the fiscal situation we're in. And I've been saying for a long time, actually, since the 2008-9 initiation of quantitative easing, that what started as a discretionary economic policy would become a deficit financing necessity, and it would therefore become a permanent feature of monetary policy. And we've had sort of a temporary break of that, sort of a feint of monetary integrity. I don't know if I even want to describe it as that, because it's so gossamer thin, it's like these curtains behind us. You could see right through it. So I continue to believe that we're looking at a situation where eventually the Fed is going to have to re-expand its balance sheet. The fact that Treasury yields have increased in the face of a Fed that's quote-unquote easing only increases my confidence that quantitative easing is coming back, and it's going to come back probably sooner than most people anticipate, because clearly the Fed's capacity to cut rates is now limited. I mean, we've seen this week the latest inflation numbers. They were already trending back up, and we're seeing confirmation of that now. And people have talked already today about sort of the inflationary implications of some of the proposed policies and onshoring and this and that and whatever. But if the Fed can't move the interest rate lever, it still has to find a way to get liquidity where it wants it. And the Treasury market is front and center because obviously everything else kind of dovetails off of it. So that's sort of my outlook. It hasn't changed my investment thesis. All I would say, and this had been my view beforehand, I wouldn't try to, I'm not Psy, so I'm not trying to short stocks. For a long time, every January would buy long-dated puts on the S&P just so I could have the intellectual vindication of making some money when this goddamn market finally went down. And I finally, it's going to happen because I finally stopped doing that to myself. So
Capitulation.
Please, right, short at your own will because I guarantee you it's coming. But so, other than that, my investment positioning is the same. I still anticipate higher gold prices, and I'm not going to describe that as a weaker dollar because the DXY index may continue to go up, but that's not the dollar. Gold is the dollar. And how it trades versus other worthless pieces of paper is irrelevant to me. So, my outlook on the stock market, I'm just standing back. I have no interest in owning stocks. I think the economy is still, got it rough sledding because we've got monumental problems we have to work through, and this situation we're seeing in the bond market where the Fed is trying to cut rates and the vigilantes seem to be coming out of their multi-year slumber is going to be one that's really interesting to watch, especially since we've already seen real credit stress in certain, the weak links in the credit chain already with delinquency rates on credit cards and autos and largest corporate bankruptcy cycle since the great financial crisis. So anyway, I guess I could have just made it short and said I have the same view I had beforehand.
This question is for Sir Stephen and for Grant. I'm speaking as a business owner. And Sir Stephen, following your map, let's say it's roughly correct, and this is a time to strengthen the balance sheet and I like your idea of holding the reserves in gold. And then there'd be a time, of course, coming where it'd be very opportune to deploy capital. But it might be a time of extreme chaos and disruption. And just wondering if you can give me some of the things that would be on your mind as you're looking at that kind of time, maybe when you're more fearful than you have been because nothing is stable, but when to pull the trigger, what to look for in that time to deploy capital. Thank you.
Do you want to take that first? Please, yeah. Okay. I have an odd view of gold. I look at it as a method of transporting real value across time through times of disruption. But at the end of the day, there is a time when you need to deploy. It's a call option on productive assets without a time limit. So gold has its most useful function as a method of storing value, but you have to use it. Just keeping gold all the time makes, for me, absolutely no sense. It's there to protect the balance sheet in a business. It's a really good way of doing it. We know from history that the danger for private citizens is that the use of gold, or the private hoarding of gold, can be made illegal. The playbook's already been written. I've forgotten when it came off the statute book, of the statutes in the US. The Roosevelt 1935, I think it was, 33 edict. I think it didn't come off until the 1980s. So they can dust that off very quickly. And I think anybody who's storing physical gold in a bank is going to find out very quickly that when they try to take it out of the bank, the metal detectors that are supposed to protect from weapons going into the bank will actually be used to detect people taking gold out, and you'll have a 90% capital gains tax, and it'll be just taken off you. And so the ability to use it in whatever circumstances, you have to want to use it. You have to know that there will be a time when it feels really uncomfortable, when you have to use that call option to buy productive assets, and that's its primary function.
We'll do one last question here in the back.
Hi, this is for everybody. Kind of like Dave, I'm old enough to remember when the stock market used to be able to use the shorthand of the rule of 20, where the PE plus the inflation rate equals 20, which we've seemed to have gotten away from the last number of years. And I'm just curious, I've been perplexed how we've seen such a sudden increase in interest rates over the last year and change, and we really haven't seen the PE, particularly on some of the growthier, popular names. They haven't given back anything. I'm curious anybody's perspective on why that is.
I think they changed it to the PE divided by the inflation rate. I think that's what happened. It's supposed to equal 20. David, you want the mic?
Well, interesting question. On the one hand, things go to extremes, but on the other hand, PE plus interest rates, and should that be nominal interest rate or a real interest rate? And we've talked today about how maybe the inflation rate's 2 and maybe it's 6 or 9 or a lot of different numbers. Maybe the real interest rate is still negative. I don't know. And so maybe stocks are right. Maybe the inflation will catch up to the stocks, or the stocks come back down. But not an easy question. Stocks seem to be overpriced. In my opinion, they're less overpriced than bonds probably are, but like other people's opinions.
You got your own.
So look, it did matter. 2022 was pretty bad when rates were going straight up, and it started to feel really bad and dangerous, and valuations were compressing, and especially in levered bond portfolios. And then go back to something I mentioned earlier, and then Silicon Valley Bank happened. And that was actually the good news, because that happened, and then they had to end it. They had to end the pain, or else it would have spun out of control. So, that weekend that Silicon Valley Bank went down, they decided that, if you're a bank and you own, and you were dumb enough to buy 1 or 2% coupon bonds at 101 or 102 in 2020, and they were now worth 70, that you could borrow 100 cents on the dollar against them at the Federal Reserve or Treasury, whichever one it was. And that ended the crisis, just like, other Federal Reserve chairmen had ended the previous 5 crises with a gigantic liquidity can kick. And, I think the markets have been benefiting from that ever since, even though rates were, the Federal Reserve, the Fed funds rate was on the surface restrictive, and Jerome Powell says monetary policy is restrictive, so they has to be lowered. But we all know, with the S&P where it is now, and Bitcoin where it is now, and gold where it is now, that monetary policy has been loose. And it was made loose again because there was some pain. And that's the story of the last 40, 50 years.
Also, looking at it from another perspective, the rule's actually intact. If you look around the world, PEs are actually pretty low. It's only one market in the whole world that's expensive. It's just that we've decided to give it a capitalization that's 2/3 of the entire world market. But maybe the U.S. is an aberration, and the rule does apply.
Different question, or rather, one thing I did want to mention, and that is in terms of preparing for a potentially catastrophic business scenario, and that is the private equity market. And private equity hasn't been mentioned at all today, and I find that interesting because there is roughly 1.2 trillion of dry powder in private equity funds in the US at the moment, and that's next to another 1 to 2 trillion of borrowing power and cash from strategics, and another trillion of family wealth that has been generated through the sale of businesses over the last 7 or 8 years to private equity. Private equity is running out of businesses to buy. That sounds like hyperbole, but if you look at the statistics of the companies in the various bands of size, from 0 to 20, or 0 to 99, and then from 99 to 250, and then from 251 to 750, and so on, you're seeing the only one that's showing any growth is the 0 to 99 space, as people are being forced to set up small businesses on the back of either forced retirement or layoffs. The fat end, the big companies, they've declined dramatically over the last 5 or 6 years, possibly 10 years. So there was about 25% less companies available. And what you're seeing is, as private equity deploys its capital in competition with strategics, that they're going down the food chain. They're moving rapidly through roll-ups, through targeted acquisitions, and deploying capital that have, even in minority stakes, which is a relatively new phenomenon. And if you want to keep your business, but bring in a strong partner or with liquidity, then sort of turning your business into a platform over the next 2 years and acquiring a private equity partner is probably a pretty good bet, because depending on how large your company is, there is a huge market for people who can create assets that look attractive to private equity, even at fairly small scale.
Do you think we could market this rogues gallery that we have here?
Can I add just one quick comment? Everybody in this room cares about value, what it's worth. The passive investor, they've been told to ignore value. And I would look at the rise in interest rates paired with a staggeringly accelerating market as an indication that we've moved from investing to a phase of speculation. Speculator doesn't care at all about value. Speculator cares about price. And so what we're seeing, to me, is not at all surprising that the crowd is ignoring rates. And the question is, at what point does the crowd awaken to that? But people have their narratives that pair with how they feel, and they're behaving to me in a very, very rationalized way.
Perfect. Well, I think we've run out of time. I'm getting the evil eye from Shannon here, and when Shannon gives you the evil eye, you better pay attention. I think all that's left to do, I think we have to announce some prize winners, right?
Your glasses are coming.
Sorry?
Your glasses are coming.
You've written pretty big. I think I can see this. Oh, dear. Oh, yeah, I can read that. Okay, right. What am I going to do with this? I'm just going to read this out. I don't think I need this. Your writing's really big. It's a bit scrawly, if I'm honest. So when I read this out, what happens?
And then I'll give you the name.
Ah, okay. Right. The first prize we're going to give away here is a signed copy of The Confidence Map by the tremendous author, Mr. Peter Atwater. And that has been won. Ah! How about that? Tamara Sheldon, where are you? Don't stand up. We'll come to you. Congratulations, Tamara. All right. The second prize, 6 months access to the finest research service on the planet, MacroMavens, authored by the great Stephanie Pomboy.
Well, I hope I can pronounce this. Robert Labita.
Where is it? Where are you, Robert? Hand up. There we go. Over there. Terrific.
Apologies in advance.
Steph. All right. This should probably be the last prize. 6 months access to the gold tier by some schmuck called Grant Williams. Okay. And the unlucky winner is Joan Hall. Joan, see, she's not even going to put her hand up. She's so embarrassed to say this. I understand that perfectly. The third prize is 12 months access, so you might want to take this. We'll find you, Joan, wherever you are. Don't worry. All right, next up, we have 6 months access to Peter Atwater's incredible financial insight commentary. This is a tremendous prize, and it goes to, drum roll please, Randy Suarez. Randy, where are you? Are you here in the room?
Where is everybody?
I guess he and Joan Hall have got the early flight. Okay, we'll find them, don't worry. All right, next prize. Hang on a second. All right, I really can't read that, Shannon.
30-minute.
Yeah. That doesn't say, come on. Okay, apparently, this call is a 30-minute one-on-one call with the tremendous Mr. Cy Jacobs, and that goes to Ken Hewitt. Ken, are you in the room, or you disappeared with Joan? Here he is, okay, over there, fantastic, congratulations. All right, next up, a 30-minute, and if you can keep it to 30 minutes, you've done really, really well. One-on-one call with Bob Rodriguez. Clear your diaries, folks. That one goes to Michael Barton from right here in Tampa. Michael, congratulations. Oops. All right, the next one, a 30-minute call one-on-one with the inimitable Felix Zulauf. And that one goes to Scott Ramsey. Scott, where are you? Congratulations, my friend. All right, next up, a 30-minute call with Doomberg, complete with his voice modulator, I'm sure. And he will wear the chicken mask if you ask him nicely. And that goes to Brett Hendrickson. Brett, congratulations, where are you? Here he is at the back there. Well done. All right. Oh, shut up. Okay, 30-minute one-on-one call with me, which we can cut down to 15 minutes if you would prefer. And that goes to poor old Andy Parker. Sorry, mate. Sorry, Andy. Do it for everybody else. Listen, I can wear the shirt. I'm kind of getting used to this shirt.
Mr. Fluffy.
Bob, we spoke about this backstage. All right, the next prize is a 30-minute one-on-one call with Stephanie Pomboy.
Oh.
Now, I was hoping I'd win that one. All right, Dale West. Where is he? Over there. Dale, congratulations. Next one is a 30-minute one-on-one call with Mr. David Iben at the back there. And that goes to Mike Weldon. Mike, are you with us? We have a hall over there, right in the corner. Excellent. Congratulations, Mike. This is the final one. All right. A 4-bottle set of wine curated for the holiday season by Somnivant. Hey, I can read that. All right. Who's going to need 4 bottles of wine?
That's a big one.
That is a big one.
She knows what she's doing.
I know she does. Well, do you want to do this? All right. All right. And this incredible prize from someone who really knows what they're doing. Yeah. In all seriousness, it is. This lady really knows what she's doing. Goes to, drum roll please, Craig Benell. Benell? I hope I pronounced that correctly. Well done. Don't drink them all at once, okay? Ladies and gentlemen, we cannot thank you enough for being a part of this. It's been so much fun for us. We've really, really enjoyed not only putting it together, but being here. And thanks to these incredible speakers who've just been so generous with their time and their knowledge. And thanks to all of you. And thanks again to Brian, Shannon, and all the staff that have made this possible. And who knows, maybe we'll see you again next year. We'll see. Thank you very much indeed, everybody.